Welcome to the Opening Bell Report.
Wait, let's just be honest for a second. Most mornings you open up your charts, you're having coffee, and a big move in the market is, what, 2%?
Right. Yeah, maybe 3%.
3% if somebody says something scary about inflation. Right.
Exactly. And in the large cap world, which is where most people live, a 3% move is a headline. It's, breaking news.
It is. It's a red alert. But then you get a day like January 26, 2026, you pull up the scanner, you're looking for some action, and you see this tiny little ticker, BATL, Battalion Oil.
Mm-hmm.
And the number next to it just doesn't look real. It's not up 3%. It's not even up 30%. It's up 211% in one day.
It's the kind of number that makes you, tap your screen or refresh the page because you just assume the data feed is broken.
Oh, I definitely refreshed the page twice. We saw stock open around, what, $1.28?
Something like that, yeah.
Which is basically nothing. And it rockets up to nearly $7 before lunch. It's staggering. And my first reaction, and I think most people's reaction is, it's a pump.
It's the natural reaction. And, usually it's the correct one.
Right. It's a pump and dump, some meme stock thing, a fat finger trade. It's easy to just write it off.
Yeah.
But today's deep dive is about fighting that instinct. We've got a stack of filings and reports here that suggest this wasn't just noise. So our mission is to figure out, was this just chaos, or was it a signal the market completely missed?
And that really is the question, isn't it? Because when you start peeling back the layers on Battalion Oil, you realize, this wasn't an algorithm glitch. This was a repricing of reality.
A repricing of reality. I like that. So let's start with the reality before the explosion.
Yeah.
Because to get a 200% pop, you usually have to start from a place of, well, total despair.
Oh, yeah.
Why was BATL sitting at $1.28? I mean, that's what we call dead money.
It was worse than dead money. It was like broken promise money. To get the surge, you have to understand the 2 years of purgatory this stock went through. It was a classic merger arbitrage situation that just went completely wrong.
The failed merger. The graveyard of so many portfolios.
Exactly. For a long time, the whole story on Battalion was simple. They were going to be acquired by a company called Fury Resources.
Okay.
The deal was signed, price was set. Investors were just sitting on it, waiting for the check to clear. It's supposed to be a risk-free trade.
Which is usually how it goes, right?
Yeah.
You buy in a little below the price, you wait, you get paid. Simple.
Until the deal collapses. And that is exactly what happened here. The Fury Resources deal just, it fell apart. It dragged on. There were funding issues, and then poof, it died.
And when a merger fails, the market reaction is just violent.
It's pure emotion. It's not about fundamentals anymore. It's about capitulation.
Everyone who bought in for that quick payday, they're all trying to get out the same door at the same time.
Exactly. It's a fire in a crowded theater. The stock crashed from that merger level all the way down to around $1.20. It became an orphan stock.
Meaning what?
No analysts cover it. It's too small. No funds want to touch it. They got burned. It's just sitting there completely unloved, ignored, and basically priced for bankruptcy.
Okay, so that creates this very specific mood. The shareholders are angry. They're tired. They just want out. But here's the twist, right? While the market was sulking about this breakup, the company itself wasn't actually dying.
No, and this is the crucial part. This is the blind spot. While the market was obsessed with the failed deal, the actual engineers at Battalion were fixing a massive operational headache. They were solving a physics problem, not a finance problem.
Okay, let's dig into that physics problem.
Yeah.
Because in the energy sector, operational issues can mean, just about anything. What was holding them back?
It all comes down to 3 words that usually make investors' eyes glaze over, but here, they're the key to the whole story. Acid gas injection.
Acid gas injection. That sounds like something from a comic book. Break that down for us. What is it, and why was it killing them?
So when you drill for oil and gas, you don't just get pure energy out of the ground. You get a lot of nasty stuff with it. One of the worst is hydrogen sulfide sour gas.
Sour gas?
It's super toxic, it's corrosive, and you can't just release it. It's illegal, it's dangerous, you have to process it, you have to scrub it out.
Okay, so you need a special facility to handle the garbage so you can get to the good stuff.
Right, and Battalion had this facility designed to take this acid gas and inject it back underground. The problem was, the facility was broken. It was totally unreliable, it kept failing.
I see. So it's a bottleneck. It doesn't matter how much oil is in the ground if you can't get rid of the toxic byproduct. You can't pump.
You got it. Think of it like a clogged drain. They were operating with one hand tied behind their back. They had the reserves, they had the wells, but they physically couldn't process the volume because this one facility was choking them.
And the market, because of the merger drama, just assumed this problem was permanent. They priced it like it would never be fixed.
Correct. They priced it as a distressed asset. But And here's where it gets really interesting. Just days before that huge price surge, news came out confirming they found a workaround.
They fixed the plant.
Even smarter, they stopped trying to fix it. The news that slipped out, the news the algorithms missed, was that they signed a deal to bypass their broken facility entirely.
So they outsourced the headache.
They connected their wells directly to a major midstream provider, a third-party pipeline company that does this for a living. So overnight, they went from their own janky equipment to plugging into a professional industrial-scale network.
Okay, that sounds like a good move, but we have to talk about the impact. Did this actually move the needle on production? Because a logistical fix usually gets you, what, 10%?
This is why I called it a repricing of reality. It wasn't 10%. The analysis report shows their gas production didn't just inch up, it doubled.
Doubled.
Literally doubled.
Wow. Okay, give me the numbers.
They went from producing around 17 million cubic feet per day to over 30 million cubic feet per day, almost immediately.
That is just wild. I mean, that's a massive step change. And think about the timing. This is happening while the stock is trading at $1.28, a price that says the company's basically dead.
Yeah, the market is looking backward at the failed deal, but the filings are showing a future where the company is twice as productive as it was yesterday.
That creates a huge disconnect. Information asymmetry.
That's the word.
Yeah.
The people reading the operational update see a growth company. The people looking at the chart see a corpse.
And that tension is what caused the explosion.
It's like holding a beach ball underwater and then letting go.
Okay, so that explains the why of the move, but now I want to play devil's advocate. The stock shot up to almost $7. Now it's pulled back. Is it possible the market just got too excited? Is there still value here?
That's the valuation glitch we need to talk about. Because even after this huge surge, if you look at the metrics compared to their peers, the stock looks confusingly cheap.
Cheap. After going from $1 to $4 or $5. How does that math work?
You have to look at the price to sales ratio. P.S. It's a simple way to see how much you're paying for every dollar of revenue a company makes.
Okay, so what's the baseline? What do other small oil and gas companies trade at?
If you look at competitors like Ring Energy or Evolution Petroleum companies in the same ballpark, they usually trade between 1 and 1.5 times sales.
So for every dollar of revenue, the stock is worth $1 to $1.50. Seems standard.
Right. Now look at Battalion. Based on these new production numbers, that 30 million cubic feet a day, even after the stock tripled, it's trading at roughly 0.36 times sales.
Wait, hold on, 0.36. So you're paying 36 cents for $1 of revenue.
That is the anomaly. The analogy in the research notes is perfect. You're essentially buying dollar bills for 36 cents.
That doesn't make any sense. Why does that gap exist? Is the market just dumb, or are we missing a huge risk?
The market isn't dumb, but it is slow. And it's fearful. You have to remember the stink of the failed merger. It takes a long time to wash that off.
For reputational damage.
Exactly. The big funds, the institutions, they hate uncertainty. They see a company whose deal just collapsed, a stock that was a penny stock a day ago, and they just stare away. That creates an opportunity for someone who can do the math now.
So the discount is a fear tax. You get the stock cheap because you're willing to touch something everyone else thinks is radioactive.
That's a perfect way to put it. But if the production numbers hold up, that tax should evaporate and the valuation should, normalize towards that 1.0x range.
Which implies a price much higher than where it is today.
Nah.
But, and there's always a but.
Yeah.
Just to look at the chart. If you bought at the top at $6.89, you are underwater right now. The stock closed around $3.99.
That was a brutal reversal, and we have to analyze that wick because it tells a story about psychology.
We're talking about that huge, long wick sticking out the top of the candle right
now. A massive wick. And a wick that long represents rejection. The price tried to go higher, and sellers just slammed it back down. But the key is asking, who were those sellers?
I have a guess. The merger victims we talked about.
That's it. Think about the person who bought this thing 2 years ago at $5, expecting the deal to close. They've been staring at a huge loss for months. They hate the stock. They promise themselves, if I ever get my money back, I am selling this garbage.
And suddenly, a miracle. The stock hits $6.
They hit the sell button so fast their keyboard smokes. That's the supply overhead. You have a whole layer of trapped longs who are just desperate to get out at break even. That's why it fell from 7 to 4.
That makes perfect sense. So now that some of those weak hands have flushed out, where does that leave us? What are the key levels on the chart to watch?
We're now in what's called price discovery.
Yeah.
The market's trying to figure out what BATL is worth now. The analysis points to 2 critical lines in the sand. First, on the downside, $3.
Why $3?
It's a psychological level. If it breaks below 3, it signals the market thinks this was just a fluke. That's the danger zone. If it holds 3, it builds a base. It says the new floor is higher.
And on the upside?
The upside is that intraday high, $6.89. And it's a big if, the stock can break through that 689 level. There's basically no chart memory above that.
You mean there's nobody left who is desperate to sell?
Exactly. All the bag holders are gone. We call that blue sky territory. And when a stock breaks into blue sky, things can get volatile to the upside really, really fast.
I love that term, blue sky territory.
Yeah.
But I have to be the pessimist here. We've painted a pretty good picture. What's the catch? What kills this whole trade?
We have to look at the balance sheet. Battalion Oil is a small company, and like most small drillers, it has debt.
The silent killer in this industry.
It is. When oil's at $80, debt is fine. If oil drops to 50, that debt becomes a noose. The market was worried about their leverage before, not just the merger.
So your betting management can use this new cash flow from the doubled production to pay down that debt.
Correct. It's a race. Can they fix the balance sheet before the oil market turns against them? That's the risk. But there's another dynamic here that's interesting. It's the battle between the machines and the humans.
Ah, yes. Algo bots versus humans.
In this case, the argument is that the algo bots, the high-frequency trading algorithms, they haven't fully figured this out yet.
How does a bot miss a 200% gain?
Oh, they didn't miss the price move. They traded the momentum. The bot sees volume up, price up, so it buys. It sees momentum slowing, so it sells. It's purely transactional. It doesn't know why the stock is moving.
Right. The bot doesn't read the PDF about the acid gas injection bypass. It doesn't know what sour gas is.
Exactly. A bot doesn't understand operational leverage. It just chases the green candle. But a human can read the filing, understand the engineering fix, and realize, wait a minute, this isn't a one-day thing. This is a permanent increase in cash flow.
So the humans have the edge because they can understand the story.
For now, yes. Eventually, the earnings reports come out, the data gets digitized, and the algos will catch up. But in this little window, there's an opportunity for analysis to beat the machines.
That is such a key point. The computers lack context.
They lack nuance. And in the microcap space, nuance is where the money is made.
So to wrap this all up, if you're listening and you pull up the BATL chart, it looks like a roller coaster. It's nauseating if you don't know the story.
But once you know about the production fix, that volatility looks different. It looks less like a pump and dump and more like the market just trying to find the right price for a new reality.
A live repricing event. So what's the takeaway? We're not giving financial advice, obviously.
No, never. But the takeaway is about level 2 thinking. Level 1 thinking is looking at the gain and saying, it's up too much, I missed it.
Or seeing the drop and saying, it's crashing, stay away.
Right. Level 2 thinking is reading the filing, understanding the bottleneck, and asking, if they are producing twice as much today as they were yesterday, why is the stock still 60% cheaper than its competitors?
It's about doing the homework, distinguishing between a gamble and an investment.
Exactly. And honestly, that discrepancy, that 0.36 times valuation, it just suggests the market is still really inefficient when it comes to these small, messy situations.
Which brings us to a final thought for you to think about. We're always told that markets are efficient, that every piece of information is instantly priced in.
But this story kind of proves that isn't always true. There are still these pockets of inefficiency.
Exactly. If a public company can literally double its production overnight and fix its biggest problem, and the market still prices it at a huge discount because it's looking at a failed deal from 2 years ago, what else are they missing?
That's the provocative question, isn't it?
What other glitches are hiding out there in the microcap sector? What other dead companies have quietly fixed their problems while the algorithms are looking the other way?
It makes you want to start reading the boring parts of the filings, doesn't it?
It really does. I think I'm going to go download some 10Ks right now. That is all for this deep dive into Battalion Oil. Thanks for listening and happy hunting.
Don't forget to like, share, and subscribe for more.